Welcome to the Purpose-Based Retirement with certified financial planner Casey Weade. Casey is the president of Howard Bailey Financial.
Whatever risk you face during your retirement years, we've got a plan.
A published author and radio host.
It's not how much we make during the good times, it's how much we keep during those really bad times.
His advocacy for retirees and pre-retirees has made him a sought-after speaker and trusted financial leader.
And putting a real plan together.
This is the Purpose-Based Retirement.
Good to see you again. I am Lee Kelso here with Casey Weade and Marshall Johnson, certified financial planners with Howard Bailey Financial. We are tapping into the thinking of some of the biggest names in the investing world today, people who manage billions of dollars. So we're going to take a look at what they're telling investors about risk, value, and the danger that can follow success. And with the market on the extended upswing we've been seeing, our financial toolbox segment today focuses on the nation's debt bomb. How leveraged are we? And what's that going to mean for you? And that has been what's fueling the market's growth. So a lot to stay tuned for. We hope you will. Casey, let's talk about some of these big thinkers in your world.
Yeah, we've got a lot of great big thinkers that have a whole lot of money that they've created out of investing in the markets and being just great investors over the years. And I think there's a lot of wisdom in these quotes. Oftentimes we think of these hedge fund managers and large mutual fund managers as individuals that have taken a lot of risk in order to get to where they're at, in order to get their investors to a point that they have at and created the rate of return that they've created for their investors and for themselves over the years. But I think what you're going to find from some of these quotes is that it's quite the opposite. They are measured risks, and a lot of what their wisdom has to do with is understanding risk and what that really means to you and your portfolio and your life savings. We're going to get a lot of good wisdom out of these people. I know I have over the years, reading different books about them. At the same time, Tony Robbins wrote a great book interviewing several of these individuals, and I hope you get just as much out of it as I have.
Now let's jump right in. Jeffrey Gundlach of Double Line. The trick is to not only take risks and be paid for taking those risks, but also to take a diversified basket of risks in a portfolio.
You know, this is really understanding what risk is, right? Risk is downside. How much can I possibly lose? It's also upside, but it's how much can I possibly lose? That is what risk is. Risk is your downside risk, and you have to really understand what that downside risk, and it's different for everyone. And when you take risk, you are gambling. Now, there's different types of gambling. Maybe you've read a book about playing blackjack and you feel like you're better at it than the average individual, but it's still gambling and it's still taking a risk. And when you look at some of these investors, you know, they're recommending to take a diversified basket of stocks, diversified basket of investments, not just stocks, but really taking a look at the broad spectrum, because if we take too many big risks too often, eventually we're going to find ourselves in a situation where we don't have anything left to risk. Yeah, and I've got a gentleman that I worked with here recently that had this issue of not understanding risk. When he came in, I said, this was our second meeting, we had already analyzed the portfolio. I said, you know, what do you think on a scale of 1 to 5 your risk level is the way you're currently allocated? He said, you know, I feel like I'm taking a little bit too much risk right now, but I feel like it's about moderate. I'm about a level 3. And as we scrolled down, he hit it right on the nail, right on the head, because that's probably what he had told his broker at some time, that I want to invest moderately, and he was a level 3. But I said, what does that mean to you? And he said, well, it means how much I could lose. I said, well, how much do you think you could possibly lose over the next 12 months with a moderate portfolio the way you're allocated today? He said, I don't know, $15,000, $20,000. Well, it was more like $120,000 to $150,000 was his downside risk over the next 12 months. He said, whoa, that's not what I thought. I can't afford that type of risk. I would panic if the market was down that much. So this is a risk that he just shouldn't be taking. We have to understand our risk.
And understand what the dollar amount is, not just that percentage. And I think that's where some people see risk as such a nebulous concept. It's like, well, 5, 10, can I handle 6, 7, 8%? Yeah. Well, what is that to you? Is that 150,000, 250,000? So boiling it down to those losses, expectation, and what can you handle, Lee?
Let's move ahead to Ray Dalio from Bridgewater. His quote is, the biggest mistake investors make is to believe that what happened in the recent past is likely to persist. They assume that something that was a good investment in the recent past is still a good investment. Typically, high past returns simply imply that an asset has become more expensive and is a poorer, not better investment.
You know what I like best? It's actually not part of this quote, but something that Ray Dalio said. He said, price is what you pay for something, but value is really what you get. That's what you're ultimately getting is the value. You could look at a stock that's priced very high, and it might actually be a better value than a stock that's very low. Typically, a low-price stock is low for a reason, and a high-price stock is high for a reason. And we have to understand that markets go up and down, right? And we want to make sure that we're not buying in at those high times. And we might look back over the last few years, and you're going, wow, why? Maybe the market can run another 5 years, maybe it can run another 10 years. It looks like it has a lot of legs, and maybe it does. However, if we know that even after market intervention in the stock market through the central banks around the world, which we're going to talk about here later in the show, even with that intervention, they can't artificially prop up the markets forever.
Yeah, what goes up must come down. Ray Dalio is famous for the all-weather portfolio in Tony Robbins' book that you mentioned earlier. There's a great chapter with Ray Dalio. I encourage a lot of folks to check it out, but focus on those assets of value.
And it all goes out the window if that crazy little guy over in North Korea does something stupid, right? I mean, there's always that risk of the unknown.
There's too many different variables. That's why you can't just sit here and say, hey, you know what? Typically, the last year, right before we hit a major bear market or recession, the market does really well. Yes, it does really well unless we start World War III, right? There's just too many unpredictable variables, and that's why it always makes sense to have a plan that's customized for your own individual situation.
Seth Klarman from Blaupost says, most investors are primarily oriented toward return, how much they can make, and they pay little attention to risk, how much they can lose.
Well, we see this every day in the office, Casey. It's all about upside. They've been having that conversation with their broker over and over and over again. I'm making 8 or 9.
All about upside.
My neighbor made 12 and I made 13. We're seeing it today because risk is on. Euphoria is here. Greed is here. Be cautious if your husband is having this conversation with you.
I've got to say, listening to the radio over the weekend, I heard an advisor that was talking about taking your home equity and taking the equity out of your home during retirement and investing it in the market, because the market has such a better return than the 3 or 4% loan rate that you're going to have by taking the loan for your house. Yeah, that's fantastic unless it doesn't return when it's done historically, unless we enter a recession and now your home's underwater and you can't make the mortgage payment because you relied on those dollars that you invested to make the mortgage payment. We're sometimes focused too much on the upside potential and not the downside risk.
Wow, really? Jeremy Grantham from GMO says you don't get rewarded for taking risk, you get rewarded for buying cheap assets. And if the assets you bought got pushed up in price simply because they were risky, then you're not going to be rewarded for taking a risk, you're going to be punished for it.
Even though you hear the media and Wall Street continually pushing and saying how great the markets are, earnings season is fantastic, it's all very dialed into these very short-term periods of time. And if you continue to chase the returns, if you chase Wall Street and continue to chase those returns saying, well, I'm only making 5, I'm going to take a little bit more risk to get 6, a little bit more risk to get 7, eventually you're going to end up like Wile E. Coyote and you're going to go right off the cliff.
I like the Acme reference there, Casey, but you know what? A millennial asked me the other day, he said, I'm sitting on some cash. I'd really like to start investing. I haven't done it yet. I said, just sit tight. Over the next 12 to 18 months, you might see a 20, 30% correction. Buy low, sell high.
There's nothing wrong with having cash. I encourage all the people we work with to hold a significant amount of cash because there's too much opportunity when we do that. I have a gentleman that I have talked about in the past that is just a really neat guy because he did really well, built up his business, and now he's getting ready to sell his business. He's sitting on this cash, and we went ahead and we guaranteed his income, and he had still around $300,000 in cash that he said, I won the game. I did win the game. I do want to get out of the market, but I don't want to sit in cash making 1 or 2%. Because hey, the market could double over the next 5 or 10 years. We just don't have a crystal ball. So we said, well, why don't we put it someplace that's liquid? We can get this cash out if we need it, but if the market goes up 20%, we don't win all the gains, but we make 10. If the market goes down, we don't lose anything, but we don't win anything, so we break even. So there gives someone the opportunity to have total liquidity. If the market's down 40% or 30%, we found better value in the future, then we can pull that liquid cash out and put it someplace else. But if we're wrong and the market continues to rise rise, at least you're participating in at least a portion of those gains every year. That's what I do with my life savings, my parents' life savings, and many of the people that work in our office.
All right, we have to take a break. We'll be right back with more thinking from some of the financial world's biggest minds when we come back.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me.
Oh, help me go to college. How will I remember you?
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
We're back. This segment, we're talking through some of the quotes from the investing world's best advisors and seeing what we can learn from them. Jesse Livermore from Speculator is the next one. The speculator's deadly enemies are ignorance, greed, fear, and hope. All the statute books in the world and all the rule books on the exchanges of the earth cannot eliminate these from the human animal.
You know, unfortunately, most people, this is how we're driven, though. We're all driven by fear and greed. Right? We're emotional beings, you know, and the only thing that's going to get you through retirement and allow you to live that successful retirement that you deserve is to have this strict diet of discipline, and the only way that you can have that is to have a written financial plan. I asked this the other night at one of our events. We had about 40 people in the room, and I said, hey, you know, who in here has a written financial plan for their future? And I had one couple over to my left that raised their hand and said, we have a written financial plan for our future. I said, well, then maybe your chances of getting there are pretty darn good. But if we never put it in writing, how are we ever going to get to where we want to be in the future? We have to put it in writing so we always have something to go back to, and we say, hey, the market's down 20%, what do we do? Well, now we've got a written plan that says, hey, we've got some cash over here that was supposed to be used to go out and buy those equities. This is over here so that we continue to draw that income during our retirement years that we always needed. You know, having a plan and a written plan can really solve a lot of these greed issues that people often have.
Well, and it takes the discipline off the decision making. You don't have to be disciplined at that point because you've got a plan in front of you. It's like somebody going on a diet and having a house full of junk food. It's of course they're going to be tempted. So fear and greed can drive a market to all-time highs, all-time lows, and it can sustain for a long time.
And it's resulted in investors greatly underperforming the broader stock market indexes. I've got a chart here that shows us that actual information over the last 30 years. We can see what that performance lag has been. And what we can see is we see great performance lag, you know, even 1 or 2%. That's the teal color, I think that is there, versus the blue, which is the actual S&P 500. And over 30 years, we can see that the blue, the S&P 500, has had dramatically better performance than investor performance, and we've seen underperformance of around 7 to 10% when investors are trying to time the market. They're getting out at the wrong time and they're buying in at the wrong time. This is factual evidence of individuals not being able to time the market because we panic when the market's down and we get greedy when the market's high.
All right, let's roll ahead here. Howard Marks from Oak Tree Capital. Rule number 1, most things will prove to be cyclical. Rule number 2, some of the greatest opportunities for gain and loss come when other people forget. Rule number 1.
Absolutely. Fear, like we just talked about, fear and greed. Take advantage of other people's greed. I'm watching a stock right now for a family that they inherited the stock, and it's gone up significantly since Trump was elected. And you know what? At some point, it's okay to take profits off the table. I realize that it's nice to see a 56% gain, but the fear of it missing out on that 80% gain can end up causing heartbreak. And never let that tax tail wag the dog, Casey.
My dad experienced that years ago with SDI stock. You know, back in the 90s, I remember him talking about it all the time. He sold out, his friends stayed in, and they were talking about how many great gains they made. Then 2001 happened, you know, and then that completely changed their outlook on that stock. And I think if we go back to part 2, was it, of this quote, or part 3, rule number 1, most things will prove to be cyclical, so let's take advantage of that opportunity we might see in the future. And I think this chart really shows us exactly what that opportunity might be. We can look from January of 1871 through 2006. 1871 through 2006, we see the S&P 500 go through these peaks, go through these valleys. It's obviously very cyclical. We have these waves of returns where we always return to the trend. We always return to the long-term average of the markets, or the mean. And today we find ourselves all the way up here, and in order to return to the mean, we have to see a precipitous fall in order to get back to that long-term average. So let's focus on that cyclical nature of the markets, or at the very least, understand it and understand where you fall. Do we have 50 years before we need those funds? Maybe it's not that big of a concern, but if we have 5 years, 10 years, or just in retirement, boy, we better be paying attention to these long-term averages.
Yeah, but so you're looking at that cyclical nature of the market, and right now we're peaking. It's frothy, as somebody once famously said. But then if I'm holding out, aren't I trying to time the market, committing the error that I just made before?
Yeah, I think we can not necessarily time the market, but be prepared for those opportunities by having a plan. It doesn't mean we get out of the market entirely, and that's where people make the biggest mistake. We don't say, hey, the market's high, we need to get completely out of the market. But if instead we say, hey, I need income for the next 10 years, what am I going to do about that? I'm going to protect that portion of the portfolio. I'm going to protect the portion for emergencies. I'm going to protect the portion for long-term care, health care. And hey, if we have the opportunity, if we're lucky enough to have 12 to 24 months of extra cash that we don't need, let's set that aside for cash. But we know what our required rate of return is. Once we know what that required rate of return is, then we can invest just enough in the right places to know we're going to get that, and we can sit on a lot of additional cash waiting for those better opportunities. Does that make sense?
Yeah, it makes sense, but also that chart is referring to the S&P 500 stocks. There's a lot of companies out there that are not anywhere close to their 52-week high, but there's others that are exceeding their 52-week high. So take the winners off the table. When things are frothy and exuberance is high, take your winners, trim the fat, take some of it off the table.
I think that's a great and very valid point that's so often not mentioned, is that there is always value in the markets somewhere. You might find the S&P 500 has a forward 10-year PE of maybe 30 or 25. However, you might be able to find some other equities, maybe internationally, that have PEs of 5 to 7. And that's a great buy at that level. We just have to have the time to do it. We can't just be buying mutual funds with a shotgun approach.
All right, let's go to Europe now with George Soros from Soros Capital Management. He says it's not whether you're right or you're wrong that's important. It's how much money you make when you're right and how much you lose when you're wrong.
Absolutely. Focusing on the risk, the downside. It doesn't matter if you averaged 8% a year for 10 years, but in that 11th year you lost 80%, Casey. It's about where you're at in life. If you're near retirement, if you're getting ready to step into retirement, focus more on the loss of capital rather than the upside.
Yeah, if you fail to manage that risk in your portfolio, if you're just doing it blindly, then you can easily give up all the previous gains that you've maybe had over the last several years. And that's something that we just don't want to see happen. I saw it happen to too many people during the 2008 financial crisis that saw those numbers of the previous year's gains or their neighbors' gains and said, you know what, I want that, and continued to be more and more aggressive. Now is not the time to get more and more aggressive. Now is the time to plan.
All right, and for the next 5 callers, here's the first step in putting that plan into place. We'd like to offer you a custom design, easy to understand, complimentary financial review. There's no obligation, no cost for this review. We're going to run a fee report so that you'll untangle what it is costing you now to work with your current planner or advisor. We'll perform a tax analysis to show you how you could potentially reduce your taxes, conduct a portfolio risk review so we can uncover unnecessary risks that you may be taking with that nest egg, and then create a customized lifetime income plan using proven strategies and techniques that really could turbocharge your retirement. So for the next 5 people who call right now at 260-482-9559, it's a comprehensive financial review with no obligation. 260-482-9559, that's 482-9559. Here's our question of the day. What is the amount of U.S. national debt held per citizen? Is it $7,600 or all the way up to $165,000? The answer when we come back.
Hi, I'm a certified financial planner practitioner. Are you one of the lucky few that will still carry a pension into retirement? Is your company offering you a buyout or a lump sum pension option? If you're seeking independent, unbiased advice from an advisor that can inform you about all of your options, then look no further. You deserve a lifetime of financial confidence due to a lifetime of income. And at Howard Bailey Financial, it's our goal to help you achieve that. If you'd like to see how a CFP professional can best serve you, give us a call today.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
Our question of the day had to do with how much debt does every citizen in the country own? Casey, what's the answer?
Well, the answer is actually C, $61,000. That's the amount of U.S. national debt held per citizen. So even my 4-month-old child and my 2-year-old each are carrying around $60,000 worth of the U.S. national debt. Now, we roughly double that number to about $150,000, and that's what each U.S. taxpayer's burden of the total U.S. national debt really is. That $7,600 number that you saw as option A, $7,600 represents the amount of interest owed by every single U.S. citizen on U.S. national debt in the U.S. The roughly $50,000, which was B, is the amount of personal debt that each U.S. citizen holds. Now, we see those huge debt numbers at $150,000, $160,000 per taxpayer, $50,000, $60,000 per individual in the U.S., and we say, well, is that what got us to where we're at today? Has the market's growth been built on the backs of the U.S. taxpayer? And I think what we might find when we really dig into the information is a little scary, and it might enlighten us to show us that maybe it's not earnings, maybe it's not the gross domestic product that we've seen, the economic growth that we've seen. It's actually more about the debt that we've been building up more than anything else. If we take a look at our total system and that total system and how it's leveraged and strip out U.S. national debt, so strip out treasuries, strip out government debt, we get a real representation of what it means. We're looking at consumer debt, corporate debt, margin debt, bank debt. This is the bank debt. This is all the debt inside our economy, outside of government debt. And what we can see is from 1959 through 1983, our total debt really tracked pretty darn closely to our gross domestic product, or basically our production as a nation. Think about it this way. If you have a $100,000 annual income, let's say that's your GDP, you're generating $100,000 a year, and you need one more dollar for each additional growth in your income. You're taking on one more level of debt. And today we find an even bigger disconnect with about $50 trillion of debt by individual versus the 18 trillion that we see in gross domestic product. And if we chart that differently and we look about how much we have to have an additional debt to generate one more dollar of gross domestic product in order to produce just a little bit more from 1959 to 1983, we saw this blue area which shows us that it was right around $1 or maybe even a little less than $1 that we would need in order to see our debt load help us grow our gross domestic product. But then with low interest rates, falling interest rates through the 80s, through the 90s, through the 2000s, as interest rates fell and debt instruments became widely used, and now we had individuals, the average U.S. citizen, living well beyond their means, we see that now we need to generate about $2 to $3 of additional debt in order to add one more dollar of additional gross domestic product, and that has led our economic growth to fall from what used to be in that 6 to 10% range now to closer to that 2 to 4% range. That's what we're seeing in economic growth today. Now let's add back in the Fed's balance sheet, and if you don't notice anything else from the show today, I think this would be that one key piece of information and one key piece for you to take away. This red line here is the Fed's balance sheet. That is how much debt that the Fed actually has on their balance sheet. Government debt is what's represented by that red line, and that used to be, the government's debt was about $800 billion, and now we see that that debt has went to about $4.75 $4.75 trillion. So it's more than doubled over the last several years, and that's been through these different quantitative easing periods. We had QE1, QE2, we had Operation Twist, and we had QE3. This is what took us from $800 billion to almost $5 trillion in total debt. And as you can see, that blue line being the stock market, the S&P 500, the red line almost tracks the blue line to a nearly perfect correlation. But now we see that that level of debt is beginning to taper off. We're seeing the Fed stop to pump money into the markets, and we've seen a relatively flat market since they've done that. However, we saw a peak up due to some of the Trump hopes, hoping that tax plans got passed, healthcare plans got passed, infrastructure plans got passed, and if that hope doesn't come to fruition, we may have a real problem, not just in the U.S., but also abroad. If we look at Bank of China, European Central Bank, we look at the Bank of England, the Swiss National Bank, Bank of Japan, we see that same trend in continuing to increase their debt load and pump money into the system is now beginning to get a little flatter, and that could have drastic consequences for the markets. If we mark that total system leverage and we graph it right along the S&P 500, it looks just like the Federal Reserve's balance sheet. The total debt of our U.S. citizens tracks almost in perfect correlation with the movements of the S&P 500. So what's your plan when all this debt reconciliation comes back to play? If we look at what happened in 2000, we look at what happened in 2008, sooner or later some of that debt has to be swallowed up, and that might happen in the form of defaults. Most closely, remember the 2008 financial crisis and the mortgage crisis that we experienced during that period of time and what it did to the market, what it did to market portfolios. This is why we have to have a real plan that doesn't just hope for the best and plan for the best, but hopes for the best and plans for the worst.
And it sounds to me like step one is deleverage your personal life.
Right, I think there's absolutely so much to be said about that. This isn't the time that we take on huge amounts of debt. You know, it's okay to have some good, healthy debt on your balance sheet, but darn it, let's get rid of those credit cards if nothing else.
All right, we have to leave it there. For the next 5 callers, we're offering a custom design, easy to understand financial review. There's no obligation or cost for this initial review. In this review, we're going to help you run a fee report to untangle what it's costing to work with your current planner or advisor. We'll perform a tax analysis to show you how you could possibly reduce your tax burden. We'll conduct a portfolio risk review to uncover unnecessary risks you may be taking in your nest egg, and we'll create a custom lifetime income plan using proven strategies and techniques that could turbocharge your retirement and make it everything you want it to be. We are taking the guesswork out of financial planning for you. For the next 5 callers who call right now at 260-482-9559, a comprehensive financial review with no obligation. 260-482-9559, 482-9559. Thanks for joining us. Casey and I will see you next week. Take care.